You've probably heard that FHA loans are a great way to buy a house with a low down payment, especially if you've got less than perfect credit. And that's true, but what's not always explained clearly is how expensive these loans can actually get over time. There are upfront fees, long-term costs, and rules that can trip up first-time homebuyers if you're not prepared. In this video, I want to walk you through the real cost of an FHA loan, not just the interest rate, but all the stuff most lenders gloss over. We'll talk about mortgage insurance, closing costs, appraisal issues, and even how using an FHA loan could make your offer less competitive in a tight market. These aren't deal breakers, but they are things that you want to know before you lock in a loan. Let's start with a quick refresher on how the FHA loan works. An FHA loan is backed by the Federal Housing Administration. They don't lend the money themselves, but they insure the loan, which lowers the risk for lenders. That's why FHA loans are so popular for buyers with lower credit scores, higher debt-to-income ratios, or smaller down payments. If your credit score is 580 or higher, you can put as little as 3.5% down. If your score is between 500 and 579, you'll need to put 10% down. Now here's where the cost comes in. With FHA loans, mortgage insurance is required no matter what. And that's the first thing that makes these loans more expensive than they seem. There are two kinds of mortgage insurance on an FHA loan, upfront and monthly. Let's start with the upfront mortgage insurance premium. It's 1.75% of your loan amount, and it's charged on every FHA loan regardless of your credit score, down payment, or loan size. Some people roll this into the loan instead of paying it out of pocket at closing, but even if you don't pay it up front, you're still paying it, and you're paying interest on it. You can check out my website, workwithdang.com, for free home buying resources like a mortgage calculator, quick start home buying guide, and a home buyer's course. I can help you find a real estate agent in your area. There's more information on my website. I make content like this every week. Please subscribe if you haven't already. Let's say you're buying a $300,000 home. Your upfront mortgage insurance premium would be $5,250. If you roll it into the loan, your new balance becomes $305,250. That extra $5,000 is part of your loan now, which means you're paying interest on it for as long as you have the loan. So you're borrowing more than the actual purchase price of the house, and that slows down your equity growth. And that brings us to the second cost, the monthly mortgage insurance, or MIP. This one sticks with you long term. If you put down less than 10%, which most FHA buyers do, the monthly mortgage insurance lasts for the life of the loan. It doesn't fall off automatically like it does with conventional loans. Your monthly MIP is based on your loan amount and loan to value ratio, but for most buyers, putting down 3.5%, it works out to about 0.55% annually. On a $300,000 loan, that's about $137 per month, or more than $1,600 a year. Now, I know that might not sound like a deal breaker, but if you stay in the home for 7, 8, 10 years, that's a lot of money that's not building equity, it's just going to the lender. The only way to remove FHA mortgage insurance is to refinance into a conventional loan later, and that costs money. We'll talk more about that in a few minutes. But first, let's talk about appraisals, because this one catches a lot of buyers off guard. FHA has stricter appraisal standards than conventional loans. The appraiser just isn't looking at value, they're also checking the property for safety and livability. That means things like peeling paint, broken windows, missing handrails, mold, leaks, or even a missing stove can delay or kill the deal. If the appraiser flags anything, it usually has to be fixed before closing. In some cases, that means bringing in contractors, getting bids, making repairs, and then having the appraiser come out to confirm it was done. And here's the part most buyers don't know. The buyer usually pays for the second appraisal visit. That can delay your closing by days or even weeks, and in the meantime, if you're renting, you might need to extend your lease or stay in a hotel. It's one of those costs that's not in the loan estimate, but it still hits your wallet. So what can you do about it? After the home inspection, talk to your lender. Ask if anything on the report could be an issue for the FHA appraisal. You can also talk to your insurance provider. Some things like old wiring or a Federal Pacific electric panel won't just slow down your loan, they could also make your homeowner's insurance more expensive or harder to get. If possible, get the seller to take care of any issues before the appraisal happens. That way you avoid the delay and you're not on the hook for the reinspection. Let's move on to closing costs, another area where FHA loans can be more expensive. You may not be able to roll your upfront mortgage insurance premium into the loan. If that's the case, it'll need to be paid out of pocket at closing. On a $300,000 loan, that's over $5,000. If you didn't budget for that, it can be a serious problem. There are also lender fees, title fees, and prepaid costs like insurance and property taxes. These aren't FHA specific, but you'll want to get a full closing cost estimate up front so there are no surprises. And don't be afraid to shop around. Some lenders charge more than others to originate the loan. It's worth asking questions. Now here's something that doesn't show up on a fee sheet but still affects your bottom line, and that's how competitive your loan is in the eyes of a seller. In hot markets, FHA loans can be harder to use. Some sellers see FHA buyers as riskier. Maybe they've heard the appraisals are tougher, maybe they assume the buyer is less financially stable. Whether it's fair or not, it can make your offer less attractive in a bidding war. You might have to offer more money or give up on things like closing cost credits just to stay competitive. That's another hidden cost. But this varies a lot by market. In a buyer's market or in areas where FHA loans are more common, you may not run into any issues at all. In fact, the sellers might have used an FHA loan themselves. Now let's go back to mortgage insurance for a second, because this is where it really adds up. Let's say 5 years from now you want to refinance into a conventional loan to get rid of MIP. First, you'll need to qualify based on your income, credit, and debt-to-income ratio. But refinancing costs money. It's not just swapping one loan for another. You'll typically pay between $3,000 and $5,000 in closing costs to refinance, sometimes more, depending on your loan size and location. And you might end up restarting your loan term. So if you originally took a 30-year loan and you refinance after 5 years into a new 30-year loan, you're essentially resetting the clock. That's not always a bad thing, especially if it lowers your monthly payment, but it is something to be aware of. Let me just say this clearly. I'm not saying FHA loans are bad. In fact, I think they're an incredible tool when used the right way. If you've got a lower credit score, a higher debt-to-income ratio, or you're using gift funds or down payment assistance, FHA might be your best option. It opens the door when conventional financing is impossible. But you need to go in it with your eyes open. The true cost of the loan isn't just the interest rate. It's the mortgage insurance, it's the stricter property standards, it's the potential appraisal delays, it's how your offer is viewed in a competitive market, and it's the future cost of refinancing if you want to get out of the loan later. So if you're looking at FHA, talk to a lender who can show you side-by-side comparisons. Ask how much you're really paying, not just upfront, but over time, and ask what it would take to qualify for conventional financing now or in the future. The more you know, the better decisions you'll make. Check out this video to learn more about FHA loans. Please like, comment, and subscribe. It motivates me to make more videos.